Howdy, Jacob here. Today we're looking at Cadence Design Systems. They are in the software industry, roughly flat market cap and enterprise value of just over $80 billion. Humongous company. They provide software, hardware services, reusable IC, integrated circuit design blocks worldwide. Their revenue is great, very consistent. In the last 10 years, the height was 19%. In the most recent year, the trough was 6.7% in 2016. Gross margins are up 3% from 86% to 89%. Operating margins up way higher, 14% in 2013 to 30% in 2022, with, again, an increase in return on invested capital over the last 10 years, over doubling. And so all these are signs of increased moats or signs of moats due to increased margins, increased return on invested capital, performing better with more money. And so let's look at their balance sheet. We see that they have just under $1 billion in cash equivalents, with debt that's even less than that on short term and long term. So very healthy balance sheet. As for cash flow, beautiful company, absolutely amazing company. The use of cash is a little bit of acquisitions, or actually a good amount of acquisitions, maybe 20%, 30% in acquisitions, maybe 10%, 5 to 10% in reinvestments, and then a lot of common stock repurchases. We're probably looking well over 50% in common stock repurchases. And so majority of the time, it looks like they're repurchasing shares, which if you look over here, again, I made a video that's saying that past performance doesn't necessarily mean it was a good idea. But if they would have bought back shares in 2016 and, at $20 a share, you made 10 times that in 10 times that in less than 10 years. So that's an absolutely phenomenal rate of return, great investment for the company. Although they may be overvalued right now, there's a chance. It was still very likely a great opportunity. And when the company is growing as fast as they are, then there's usually not a lot of times where it's bad to reinvest back in yourself by buying back shares. But again, every use of free cash flow should be balanced with what can be the return that I get from this. And so if the company is going to be growing at 12%, that could make up for a depreciation in PE over a 30-year period to where it averages out to a 10-11% rate of return. But over the short run, it might not look as pretty. So I'll get ready to make some assumptions. I'm going to say that they'll probably grow close to 8% a year. I'm going to say 20 and 20 on the P and price to free cash flow. The margins have been going up, so I'll probably be going on the higher end of all of these. I'll say maybe, and free cash flow is higher. I absolutely adore that. Let's say 28, 32. Maybe they buy back 1%. Oops, opposite. They buy back 1% of shares because their stock-based compensation is up to $312 million a year, which is pretty hefty. 312 million in comparison to their 80 billion market cap, obviously nothing too fancy, but on their production of $1 billion, even if they were to buy back $1 billion, that would barely be over 1% of shares repurchased. And so I'm just doing it off the fact that they've bought back a lot of shares recently, and so I think that they could keep that going and still have, maybe I'll do, they buy back 0.75% of shares a year over the next 7 years, because that would give them more opportunity to make acquisitions, reinvest in themselves and such, without really having to go into debt. And so right now, it just makes sense. You look at the current P of essentially 80, it just makes sense that it's a little bit overvalued. You can always make something make sense, but to me, I'm always a bit more conservative. And so, do I want to own this company? 1,000%. It looks absolutely fantastic. It meets all the criteria. Great balance sheet, gushing cash flow, increased return on invested capital, increased margins, huge increase of growth. But there's always, every investment is the price you pay. And I think at this price, even over a decently long term of 10 years, I just think that there is going to be a depreciation of the PE and price to free cash flow enough so to where the investment might not make all the sense in the world. But hopefully you enjoy this video, and hopefully it's reviewed in conjunction with your own analysis. And I hope you have a fantastic rest of your day. Thank you.